Hey guys, thanks for joining me for this one. In this video, I'm going to be talking about 3 top stocks that are currently on my watch list. Some of these companies I've dabbled into and then sold in the past, but these are 3 stocks that I'm really looking into potentially adding to the portfolio if the price point gets right or if they report a really strong earnings numbers and I feel like I just really need to have them in my portfolio. So we're going to go through these stocks one by one. Before that though, if you like this type of content, be sure to give this video a big thumbs up for the YouTube algorithm. For smaller channels like myself, it really does help get the video out to more people. Okay, so stock number 1, you may have heard of me talk about it before on some other videos, but Jamieson Wellness is definitely a stock that I'm very interested in. Just looking at this stock high level here, over the last year, this stock is down about 14%. It's at a $1.3 billion market cap, trading near the low end of its 52-week range at $30, whereas they went down to $29. Pays over 2% dividend, and they've actually increased that dividend annually since they became a public company, I believe, 5 or 6 years ago. Looking at this company over the long term, you really see they had a big boom during COVID, going from $26 before COVID all the way up to over $40 as more and more people use vitamins. But lots of the trends, and if we look at the sales, lots of the sales have actually increased, but their multiple has greatly reduced. So this is obviously mostly a dynamic of just interest rates going up, valuations getting crushed. But I think that at the current multiples, this one is an interesting buy. Going to go into the price to earnings multiple in a little bit. But before getting into that, wanted to talk about a couple things that they're doing on their business. The first thing is they currently have a big vitamins business in Canada. They're really investing in China right now, and then their other form of geographical distribution is across Europe and Africa, I believe. So they did not have a big presence in the US by any means. And they recently just made this acquisition of Theory. I guess the parent company is NutraWise, but this was, I believe, $100 or $200 million acquisition at a reasonable valuation, giving the free cash flow and earnings that this company or this brand is spitting out. So it's just lots of additional synergies that folding this company into the Jamieson Wellness Company will provide. And if this helps Jamieson get their namesake brand into the US and into distribution, I believe Theory primarily operates on e-com as well as retailers on the west side of the country. It could be huge in terms of another growth vector for the overall business. Just wanted to look at a couple other things in terms of the opportunity here. So they're looking at a vector or a ton of different things when deciding whether to make acquisitions, and it just makes a lot of sense. They're going to get tons of cost synergies. They make similar types of products. They can leverage the Jamieson portfolio with Theory. They can potentially expand their Jamieson brands in the US, new premium branding and just opportunities to cross-sell these 2 franchises. So I actually really like this acquisition. The second thing that they recently invested in is buying out their wholesaler in China. So they kind of entered China a number of years ago with an option to eventually buy out their distributor, that was selling their products in the country. The business did really well under this distributor, and they recently bought the business from them. And then in turn, they partnered with one of the best companies who commercialize US brands in China. That company actually invested in the Chinese division of the company that they just bought out completely from their distributor. So lots of strategic moves going in China. Essentially just an area that the company is more incentivized to grow and more invested in than they have been in the past as they look to redirect more and more investment there for future growth. So really like that as well. In addition to having a really profitable cash cow business in Canada, they're really looking at driving top line and down the road earnings per share growth in China, which is a huge market, especially when we're talking about the size of this company being only $1 billion. Mentioned it earlier, but you can really see during COVID, revenue exploded was probably about 330, 340 million pre-COVID, went up to 400 million in 2020, so a nice 20% jump there. But we really don't see any signs of decline. This is a bit misleading because it's counting the acquisition that we mentioned earlier, which I think was about $50 million or so of annual revenue. But still, if I even take that out, you're continuing to get double-digit organic revenue growth over the medium to long term, as well as in the current guidance of the company. So really like to see that, and really usually that gets companies trading at a more aggressive earnings multiple. Lastly, we talked China, we talked Canada, we talked them jumping into the US. Another area that's been slowly growing nicely for them is just expanding their international distribution. So you see Middle East, Southeast Asia, Mexico, Croatia were a couple new countries that they expanded into. So this brand's now in 50 plus countries. So while maybe very small in some of these companies, or some of these countries rather, they're slowly building a global footprint that they can then invest in across multiple different regions and make a global brand. And at the end of the day, if they can do that effectively, they can carve out a big business in China. This company can be worth a lot more than 1.2 billion Canadian dollars. So going into valuation, the current valuation for the stock is about $1.60. So looking at current earnings, that means, or current share price rather, this means that the company's trading at about 18 to 19 times current year earnings. Going into next year, they're expected to make closer to $2 a share. Some analysts that are a bit bullish have them making $2 a share, which would have this company trading about 15 times. This is a company that's compounded top line double digits and bottom line faster than top line over the last 10 years. And they're just now investing in tons of capability unlocks across the US, new brands, China as a market. So if anything, it looks like they're ready to put their foot on the pedal in terms of growth here. So really surprised to see this company trading at a multiple under 20 current year earnings and a projection for 15 times almost next year's earnings. So I just think solid business, very limited downside. Lots of people buying these products do it for health purposes. And just from a health trend point of view, there's probably a lot more upside than downside as we go into the next decade. So I really like this name. I think it's a good business trading at a great valuation is how I characterize it. And that's why I definitely have it near the top of my watch list here. Going into stock number 2, a bit lower conviction on this stock, but hear me out. Recently, the WWE announced that they were trying to sell themselves, as Vince McMahon at the time was having a lot of PR issues, as well as he's just getting really old. He was the controlling shareholder of the WWE. You can kind of see the spike here. So this company behind that news has really essentially doubled in value, right? Up from $50 all the way up to $100. Why I'm interested in this company is the new entity that this company ended up merging with instead of getting a formal buyout was the UFC, which is getting spun out by Endeavor Group. So the new company is going to be a combination of UFC and World Wrestling Entertainment, also known as WWE, which I think is such a cool concept. They're going to have tons of power in terms of media rights and negotiating media rights, streaming rights. They're going to have crossovers of entertainers across both platforms. At the end of the day, UFC is just full with entertainers as well. That's their business, even though it's less scripted. It's a big opportunity for them to bring that credibility to the WWE, and I'm sure they can do a lot of fun things the other way as well. Who knows? Maybe they can mix up some of these events and have WWE and UFC events taking place in the same place. Who knows? But I think it just has a lot of opportunities to create a lot of buzz. And at the end of the day, the vast majority of this business, as we go into kind of their revenue breakdown here, comes from media rights. So you can kind of see here, $333 million in revenue last quarter, 278 came from media. So 80% of the business, pretty much 100% of the profit, if you look at it from an operating income standpoint. So this company is a media company. They're also looking at investing into sports gambling a bit on the side as well. So this is going to be a really interesting opportunity. I do think it's probably a bit richly valued, but it's going to be really convoluted and interesting to see how the value changes as they morph in UFC to the company, release new shares, and this one will be a new publicly traded company that these shares will eventually spin into. A couple things I just want to talk here. You kind of get the point that the media rights are the big trophy asset here that WWE's created. Since they have such loyal fans, they bring people in to watch every Monday, every Friday pretty much, and then their pay-per-view events are huge as well. You can kind of see on average here, this quarter looked a bit wonky, but generally after tax, this company brings in 50 to 60 million bucks a quarter like clockwork pretty much. So trading or bringing in $200 to $250 million of net income. If I give them the benefit of the doubt because they're signing a new media deal next year, $250 million of net income, $7.5 billion valuation on the WWE side of the company currently being given. That is literally a 30 times PE. So you are paying up for WWE at these levels with the hopes that they can sign a media rights deal next year that gives them, you know, a 30% raise, a 40% raise in how much money TV networks and streaming networks are paying them for the product. That would bring the multiple down to something a bit more, you know, reasonable. But I think that's definitely been priced in here. So this one will be really interesting to see how it pans out. I think the new company will be really interesting, but I haven't really bought into it in any meaningful way ever, just because of the starting valuation being so aggressive to begin with. But I'll definitely keep this one on my watch list. Going into the third stock on my watch list here, and as a bit of a spoiler, I started averaging into this one in very small amounts. I think I have like 10 or 15 shares in this stock, so really nothing really in the grand scheme of my portfolio. But VICI Properties, going back on this one, this company's up 50% over the last 5 years. That's not including the 5 to 7% dividend that they've been paying out. In the last 1 year here, you can see they're flat, which is actually phenomenal for a REIT. And they've really just started dipping here in the last 5 days. That's really when I said, you know what, I'm finally just going to jump in, because it's never a great time to buy assets that are just doing phenomenally well and have really high intrinsic value. So just jumping into VICI a bit, $31 billion company trading at a 30 times or a $30 stock price. They make about $2 a share, 50 cents a quarter in funds from operation. So $2 a year in funds from operation. And you guys can do the math on that. They're trading at about a 15 times funds from operation multiple. Out of that, 6 to 7% yield on cash flow. They pay about a 5 to 5.5% dividend, and the rest goes into repaying debt, looking for growth opportunities, etc. So pretty fair multiple, I'd say, given the success they've had over the last number of years. Just looking at their assets here, about half of their business is in Vegas, but they do have a lot of other regional assets here. 53% of their overall rent, and you can kind of see all the different states that they operate in here, and some great assets if you just want to read up and down the left and right side of the chart. You can pause the screen. Here's some of the top ones highlighted. You really see some iconic brands and assets. Caesar's Palace, they own, the Venetian, MGM, lots of Hard Rocks, Harrah's, lots of their properties as well, some retail in Vegas as well, entertainment venues, world-class entertainment venues, and convention centers. So they're really in the entertainment space, triple net leases, huge leases down 20, 30, 40 years in the future with CPI adjustments built in for protection. And one of the sound bites they always use is during COVID, despite rents going up behind CPI and inflation increases, they have yet to miss a rent payment, or any of their tenants are yet to miss a rent payment since this company got turned into VICI's Properties. So they have 100% rent collection essentially, and that was a huge test during COVID to see if that would consistently be maintained, and it did. Just looking at where half their business is here, which is on the Strip, kind of see they have really good coverage. The other thing I love is I believe they also have a lot of empty land 660 acres of underlying land across the Las Vegas Strip, in addition to VICI's existing call rights of another 28 acres pertaining to Caesars Forum Convention Center. Sorry to read that all out loud. But at the end of the day, this company is trading at a 15 times earnings multiple. They have a lot of opportunities organically to develop or sell this land to lower that earnings multiple by buying back shares or using that capital to invest in new income streams on the same amount of share base. So I think with the CPI increases that they have baked into their leases, the land that they have, and their ability that they've shown to make accretive acquisitions, you can potentially be getting a relatively safe high single digit to 10% long-term return on investment with this company, which, given the fact that they've never had a tenant miss a rent payment, despite that they went through COVID in the entertainment space, I think that's a good test to their moat and just the value and the pricing power they have with the assets that they own. No one wants to get kicked out of these assets because their businesses are super valuable, and it's pretty much entirely driven by where they are on the strip. So that's my thoughts on it. This probably won't be a huge position for me, but it's definitely one that I think at 15 times current earnings, with all the opportunities they have to grow earnings or monetize existing assets that the company owns, this one's in a very fair spot. I'll put it that way. Just an example of one deal they recently did as they continue to deploy capital, drive accretive purchases across the portfolio. They bought four casinos in Alberta, Canada. So they kind of mentioned it as dipping their toes into the international market, putting their life jacket on, so to speak. Canada's a pretty simple market relative to the U.S. and very similar way of doing business, economy, stuff like that. But they said this may serve as a test to expand more in Canada or overseas in London and Japan. They were talking about a bit on their last earnings call. So we'll see how this one goes. Their acquisition cap rate is about 8%, which is a couple percent higher, about 1.5 points higher than their overall portfolio now. So maybe a bit less iconic of an asset, making them get a better yield up front. But good to see they're continuing to deploy capital and shareholder capital in a way that's going to continue to grow funds from operations per share, earnings per share, dividends per share in the long run. And then just some sound bites in terms of strategies. You can pause and read these if you want, but this is essentially the four casinos that they bought in this acquisition in Alberta across Edmonton and Calgary. A racetrack included there too. So that's all I got for you guys in this video. The three stocks I'm really watching and may make a bigger splash into: Jamieson Wellness. WWE is probably the lowest conviction, but I'm just personally really interested to see how that merger takes place. And then VICI's one that on this last week's weakness, I actually did start nibbling. Would love this one to go under 30. Would start building it into a much bigger position. So hope you guys like this content. Let me know if you're interested in any of these stocks, if you own any of these stocks, if you have any thoughts. Love to hear from you in the comments. And if you've watched through this entire video, I really appreciate it. Let me know in the comments if that's true. And if you haven't yet, be sure to hit that thumbs up button. It really does help the channel, and I appreciate it a lot. Thank you guys for watching, and I'll see you in the next one.